Union Pacific to reshape U.S. freight rail with $85 billion deal for Norfolk. The deal would create a U.S. transcontinental freight giant, the first time in a very long time that the United States has had a transcontinental railroad. The only thing standing in the way is the STB, which is the regulatory body for transportation in the United States. This is a little bit ago, so July 29th, Union Pacific said on Tuesday it would buy smaller rival Norfolk Southern in an $85 billion deal to create the first U.S. coast-to-coast freight rail operator and reshape the movement of goods from grains to autos across the country. So let's take a look at those two maps. So this is the map of Norfolk Southern and the regions that they operate in. So they do have approximately a third of the United States, as opposed to Norfolk Southern, which primarily operates from Chicago to the east. Norfolk Southern has about 20,000 miles of rail that cover the entirety of the eastern third of the United States. If they were to combine, then you would have one giant operator operating across the entirety of the United States. The two railroads are expected to have a combined enterprise value of $250 billion and would unlock about $2.75 billion in annualized synergies, the company said. The $320 per share price implies a premium of 18.6% for Norfolk from its July 17th close. The deal will face lengthy regulatory scrutiny amid union concerns over potential rate increases, service disruptions, and job losses. The Surface Transportation Board chairman, appointed by Trump in January, will head the agency and oversees competition and other areas of economic importance in the rail industry. He has advocated for faster preliminary reviews and a more flexible approach to merger conditions. The DOJ, the DOT, and the FTC can all intervene whenever they want in the merger process and say, hey, we believe that this is not a good idea. It is very unlikely that the FTC or the DOJ will intervene. We have the Surface Transportation Board, and they are the ones that kind of have the final say in whether Union Pacific is allowed to buy Norfolk Southern. So the proposed share price is $320 per share, and they're currently trading at $283. So you can get 11% if you go out and buy Norfolk Southern. So Union Pacific and Norfolk, both of those shareholders, already agreed to the merger agreement. And so the only thing that stands in the way is the STB. I was reading this a little while ago. In a $31 billion deal, Canadian Pacific went out and bought Kansas City Southern. So Canadian Pacific expanding their footprint in the United States by buying a big railroad carrier, and the STB didn't step in to stop it. Union Pacific very likely feels emboldened to attempt their merger with Norfolk Southern, and you know, it sort of makes sense. Union Pacific thinks that they can get some operational efficiency out of the combination, but there seems to be a bit of a problem. If you remember, Norfolk Southern was involved in the East Palestine train derailment. So a proposed mega merger of two of the largest railroad companies in the U.S. will hurt jobs, raise costs for consumers, and increase the risk of more catastrophic train crashes, according to workers and unions. When the firm says that it expects annualized synergy savings of $2.75 billion, this means cutting staff. So obviously, as companies get bigger, they get more power, and specifically power over their people that work there. If you're to allow a merger of these two gigantic companies, you're basically taking even more power away, because this is going to embolden the combined Norfolk Southern and Union Pacific Railroad Company to, you know, cut jobs and to cut back on like safety measures and all that sort of stuff. In fact, we have an op-ed that I was reading earlier today, which I found quite good. The Norfolk Southern Union Pacific merger is wrong for rail. The advocacy organization argues it's time to reject Wall Street's massive power grab and renationalize America's rails before it's too late. Nationalize. What an interesting idea. The proposed $85 billion merger of Norfolk Southern and Union Pacific isn't about creating a more efficient coast-to-coast network. While executives promise efficiency and connectivity, past mergers show the truth: job cuts, safety shortcuts, degraded service, and higher costs. Combining two of the nation's largest railroads would entrench monopoly control of U.S. freight corridors, reduce competition, accelerate automation and de-skilling, and further weaken rail labor. Now these same executives want to merge Norfolk Southern and Union Pacific, a deal that would dwarf the recent Canadian Pacific Kansas City Southern merger. The results are predictable: fewer jobs, fewer safety inspections, longer trains, and more fragile supply chains. The STB is understaffed and dominated by former industry insiders, places the burden of proof on shippers to challenge excessive rates, a process that takes years and costs hundreds of thousands of dollars. Even successful cases have no wider effect. The FRA relies on self-reporting and imposes fines so minimal they're treated as a cost of doing business. These agencies were built for a competitive market that no longer exists. Their authority has been hollowed out while railroads consolidated into regional monopolies. In this environment, consolidation doesn't slip through the cracks, it thrives in them. If regulators couldn't stop the $31 billion merger of Canadian Pacific and Kansas Southern, there's little reason to believe they will protect the public from an $85 billion deal between two even larger carriers. This article, op-ed, I do not necessarily agree with all of it. However, it makes some good points. It calls for the complete abandonment of this merger. They want the STB or the FTC or the FRA to step in and say, hey, we actually don't think that the Norfolk Southern and Union Pacific combining is a good thing, because in the past, we've seen, especially with Canadian Pacific and Kansas City, we've seen this is detrimental to workers. It's detrimental to the actual railroads, because what happens is when you get this consolidation, all of a sudden Union Pacific and Norfolk Southern can run the same cars on the same trains instead of needing to do it separately instead, which would normally be the case. So if Norfolk Southern needs to transport something, they could just attach to a Union Pacific car now if this merger were to go through. And obviously there are cost savings in there for both companies, but at the end of the day, you get longer trains, which is longer waits at railroad crossings. When companies merge, you get the loss, the fundamental erosion of not only worker safety, but you also get the fundamental erosion of actual workers at the job, because these companies are going to look for synergies. They're going to cut unnecessary workers, unnecessary being people that were incredibly necessary for the companies that they worked at, which are no longer necessary for a company that's combined. The thing that comes to mind is like an HR department, right? Both of these companies probably have two separate HR departments. If they combined, maybe you get one big HR department and you can cut the staff by 20%, which is just not great. And also, if you're combining railroad cars and trains together of these two different companies, you probably need less conductors. You probably need less people on hands on the actual trains. So it's great for like this illusion of like efficiency, but it's not great for the actual workers involved. I think there are a lot of problems sort of fundamentally with this deal. I do not think that it should get approved. However, I do believe it will get approved because we are currently in a very lax regulatory environment where the people running the regulatory agencies do not have the power, they do not have the staffing, they do not have the authority, I think, in favor of workers. Now, this obviously comes across as very pro-worker and very anti-Wall Street. And I think fundamentally, yeah, if you look at it from like Wall Street's perspective, they definitely want this. Obviously, both sets of shareholders from both companies have already agreed to the merger. They're just waiting for the regulatory bodies to approve it. And this is great for business, right? This is great for business because, you're cutting costs, you're getting a transcontinental railroad, you're probably going to make a ton of money, your already massive profit margins are going to continue to expand. And so this is a great deal for Wall Street, but it's a terrible deal for Main Street. But from an actual investing perspective, Norfolk Southern, of course, is currently trading at $283 per share. They have been offered $320 per share. It's about $40 per share, which is only about 11%. If you believe, such as myself, that the STB will go ahead and approve this merger, then it would, I believe, behoove you to go out and buy some shares of NSC because you're literally just getting paid to sit around and wait.